Oracle of Omaha has been liquidating his bank position. So today we're going to analyze this news, take a look into the balance sheets of these banks, and tell you what my favorite U.S. bank is, because last week I told you what my favorite Canadian bank was. So let's jump right into this.
Drop it.
Welcome back, my passive income investors alike. So we're going to read through some of the key statistics here, and then we're going to divulge our way into the balance sheets and figure out what the best U.S. bank is you should be maybe buying into. Ladies and gents, kicking this all off, Buffett has remained relatively quiet during the CV market downturn. Rather than make an elephant-sized acquisition, he trimmed Berkshire holdings, mostly banks and airlines so far, and grown his cash pile to $137 billion. The Oracle of Omaha's biggest recent move was the sell-off of most 84% of his stake in Goldman Sachs, a long-time holding which he famously invested $5 billion into during the 2008 financial crisis. Buffett decreased his stake in Goldman, which saw its stock plunge over 30% for the first quarter, from over 12 million shares to just under 2 million. His remaining investment is valued at around $330 million. My goodness, that is still a huge chunk of change to me anyways. Probably not to him, but me nonetheless. Berkshire Hathaway cut its stake in another bank, a JPMorgan Chase, and that was by about 3% in the first quarter, while also fully exiting his position in the insurance driver Philip 66. Berkshire cut its investment in e-commerce giant Amazon by 0.7%, which came as a bit of a shock to me. I felt like Buffett was kind of itching toward like the growth sector with Apple, Amazon, and I figured, that's the way the future's headed. But nonetheless, still cut that down. Berkshire has been doing some small-scale buying during the pandemic as well. However, Buffett ended up boosting the conglomerate stake in PNC Financial Services Group, a bank which is among the biggest lenders in the United States. Ladies and gents, we're going to get into that company as well, but let's just kick this off by going over the banks real quick. We're going to analyze, and then we're going to kind of cut into those balance sheets and see if they can even afford the dividends still today. Starting with Goldman Sachs, obviously paying a 2.76% yield, PE ratio of about 9.8, and this one is down, like they said, sitting about down 27% on the year. Taking a look, we got JPMorgan here, guys, paying a 4% yield, which starts looking much more attractive. A little bit higher of a PE ratio, and this one's also down, right now? About 34%. We got Bank of America, down with a PE of 9.2. We got a dividend yield of 3.18, and again, this one is also down 35% year to date. And then finally, my worst investment I've made as of recent, which we'll take a look at as well. We're talking about Wells Fargo here, ladies and gents. This is the worst performing bank of the bunch, and we're going to find out why when we look at those balance sheets. From its all-time highs, it's just getting slaughtered. It's returned to its basically 2008, 2009 prices. And this is a stock that had no problem cutting its dividend in the 2008 financial crisis. And right now, the yield is 8.26%, which I'm going to presume isn't that safe. And again, we're going to take a deeper look at that. And then finally, the last one we're going to kind of analyze is PNC Financial, because that's the one Buffett just bought into. So let's figure out why his interest is here with a 4.9% dividend yield. Again, the average PE seems to be between 9 and 10 on these financial companies. But starting it all off, let's take a quick peek here at Goldman Sachs. And these stocks, man, as soon as you go into these balance sheets, you can completely figure out why Buffett's getting a little itchy on, what the future outlook's going to look like here, guys. But taking a look, we can see that the net earnings were about $1.2 billion for the quarter ending 2020, but just stepping back 1 year into Q1 of 2019, they made about $2.1 billion. So that's like a 50% drop in earnings here, which is painful, guys. But let's take a look at the diluted earnings per share real quick, which we can see is about $3.11. Now, can they afford to keep paying that dividend? The current yield is about $1.25 per share. So yes, from what it seems to stand today, they got lots of room to continue paying that dividend. But again, we don't know how bad these companies are going to burn. You're going to have to really deep dive down into these things if you want to figure out where they're losing most of the money, what the exposure, the debt exposure is, and how safe it is, because we could keep seeing burning, guys. I mean, this is is only we're the second month into this full shutdown, and I mean, it's completely cut their revenues in half. So let's take a look here at JPMorgan, another one that he's lowered his share position in, and we can see that here for Q1 2020, the earnings per share were 78 cents over Q1 of 2019, guys, of $2.65. I don't even know what to say to that. My goodness, guys, that is a huge haircut. And I mean, if we take a look at JP Morgan's dividend of 90 cents, it's quite clear as of this very moment they can't actually afford to be paying that dividend. And I don't know if they've done any amortization here or if they've done some write-downs on some of their assets, meaning they might actually be able to afford the dividend. It's kind of like real estate, right? Like, I don't know how much of that all plays in. You'll have to figure that out for your own. But nonetheless, let's take a look at Bank of America. Bank of America. Taking a look, guys, this is actually my favorite bank, and you're going to find out here why in a sec. But we can just take a look. And the reason I also love Bank of America, at least on their balance sheet here, they put the dividend paid right next to the EPS, and so I don't have to dig around for it. But taking a look, guys, their diluted earnings was 40 cents per share, again, over the Q1 of 2019 of 0.7. So they're actually having a little bit better bleed room here compared to the last two we were just looking at. And with the dividend, actually, that was increased this year to 18 cents. We can see they have plenty of room to continue paying that dividend. So there's some comfort in Bank of America. Now let's take a look at the one that I'm getting slaughtered on the most is my Wells Fargo position, ladies and gents. You just take a look at my holdings here. Thank God this is the smallest position in my six-figure portfolio. It is actually the smallest position next to MindMed here, but I only have, I think, about just under $1,000 in it. But look at how much I'm down, 49%. Thank God it's not a real drop in the pond. But take a look here, guys. They've showed an earnings per share of Q1 in 2020 of 1 cent. 1 cent compared to Q1 of 2019 when they showed $1.20. Be a little iffy on that one, ladies and gents. That's some scary stuff. I don't even have to look at their dividend to tell you that that's probably not even well close to the 8% they're saying they're paying out right now, right? But let's take a look finally at this PNC Financial Corp, and we can see that their net income here, if we scroll up again. So keeping our alignment here, because all these balance sheets are slightly different, this line here represents the Q1 of 2020, and then if we go back, we can see at the very back, here's Q1 of 2019. So let's just scroll back down here and take a look at that net income, or we can see earnings per share, and we can see the diluted EPS is $1.95 for the first quarter here, going back into 2019 where it was $2.60. So this company, I can see why Buffett finds it attractive. It has actually had some of the best it is actually the best performer over everything we just looked at. And I wouldn't be surprised, guys, taking a look at that dividend yield. Let's go back to PNC because I don't know what their actual dividend is unless it was in that balance sheet and I just missed it. But let's just go PNC stock dividend. And we can see that their dividend's $4.60, which if we were to divide that by 4, that's what, $1.15 per share. So itching pretty close. Again, if we're sitting at $1.15 on the dividend and we're looking at $1.96 diluted, I think some of the banks have safer room compared to this company. I haven't looked into this at all. I don't know how they're leveraged and how safe their leverage is, but presuming this is like the worst case scenario. But again, we've only been shut down for 2 months here, guys. We don't know what the rest of May, June, or July is going to look like on those next quarterly reports. But this is where things get pretty utterly terrifying. Considering we're already, 50% down on some of these earnings, I would be very, very cautious with these banks. There are things that I've been approaching very cautiously, primarily focusing on the Canadian banks because I trust them a little bit more. And taking a look at kind of like my Canadian banks here, guys, I'm down massively on them, but I have no plans on selling them. And I'm going to tell you how you kind of need to look at the banks from an investment standpoint, or how I look at them anyways. And my kind of perspective on this is I don't care about equity growth. I really don't care if the stock goes up or down. I'm going to be holding on to this thing for the next 30, probably until I die. Let's be realistic, guys. We're holding these specifically for dividends. Yes, do I wish I was buying them today? Absolutely, which is why I keep saying these might be some of the greatest investment opportunities of your life. Are you going to get a huge amount of growth out of these? Probably not. They haven't been good equity growers for the last 5, I'd almost say 10 years in the Canadian sector nonetheless. But even still, guys, we're holding these for cash flow. And when that cash flow consistently comes in and that reliable income comes in, because a lot of people have gotten dividend cuts, but my banks here have not cut those dividends, and you can use that money to reallocate it in any way you want. I mean, you could do share buybacks and, infinitely start growing your dividends. You could take it and put it into growth stocks, pay your bills in these hard times. That's why I own them. So I'm not really looking at the equity side. I'm still buying my Canadian banks. I'm not buying Wells Fargo. I'm pretty happy with where my financials are at. I'm only really buying into them because they are down so much. And you guys know what I'm doing here. You just got to hit a like and subscribe, and you'll see the progression of my portfolio as things go on. And if you guys want to learn a little bit more in-depthly how I look at my stocks, how I analyze them, you can head on over to the Passive Income Educator. Thanks so much to all of you that have been supporting me through these rather rocky times with my career, my job shift going on here. But you can come in here and learn everything from stock market investing. You can book us for one-on-one talks where we can actually take a look at your portfolio, have a real conversation. I mean, it's just fun all around, but you don't have to do that. You can come here and watch this channel for free every day, guys. So stay cool, stay awesome, and I'll catch you tomorrow.